Coming up on episode 6 of Hard Fork, Pietro Ventani. Meet the leaders in blockchain and the future of finance. This is Hard Fork.
Welcome back, Hard Forkers, and a special welcome to anybody new finding us at the moment. This is episode 6 of our Hard Fork series with myself and co-host Lawrence Grinceri. Welcome back, Lawrence.
Thanks, Sean. It's good to be back, and hello from sunny Perth.
Yes. We've got a fantastic panelist joining us today, Pietro Ventani, a Singapore-based economist, investment strategist, and early-stage tech investor. Welcome, Pietro.
Hi, guys. It's good to be with you today.
Yeah, so listen, in today's show, we're going to address a number of topics here, but having Pietro join us, we really wanted to start big picture, the big story, the macroeconomic environment that we find ourselves in, Pietro. We got in touch with you. We think you're one of the better people to help educate the audience on what the hell is going on. So maybe if you could tell us a bit about yourself and then what you see happening from that big story point of view.
Sure. I'm an economist by training. I have a PhD in economics and an MBA. And I had, after about 15 plus years working in big corporations, I decided to focus on essentially macro-driven investments, and I developed asset allocation models primarily for family offices. So that's what I do. Over the last 5 to 7 years, I've become more and more interested in early stage technology investing, and with a special focus on fintech and blockchain. Okay. So this is my background.
So Pietro, talk us through the harsh facts that are facing everybody at the moment from a macroeconomic point of view. What's going on?
Yes, I mean it's really, frankly, first of all, this kind of dynamics play out over several years, decades, typically. But COVID has massively accelerated certain trends that were already in place over the last 10 to 15 years. And in a nutshell, the key element, the key sort of the tip of the iceberg of what's going on is in one word can be summarized as debt, increasing level of debts in the global economy. Just to give you an idea, 2020 ended with $277 trillion of debt, which is about 350% of global GDP. And in 2021, we already know that because of COVID, this debt will continue to increase at an accelerated pace. Why is that important? Because when debt reaches a certain level, in essence, first of all, it starts to have a very adverse impact on the economy, what is called the zombification of the economy. In other words, the natural work of the economy can no longer play out because there is so much debt in the system. That's the first effect. The second effect, which is obviously very relevant, the second sort of consequence of too much debt, very relevant to investors, is that beyond a certain level, that debt cannot be longer repaid in an organic way, and therefore has to be worked out. And history, as always, is a very good source of insight on how that debt is likely to be reduced. And to cut a very long story short, the odds that sort of the majority scenario at this point is that this debt is going to have to be worked out through currency devaluation, meaning given the fact that at this point the biggest debtor in the world are governments. Governments are going to have to maneuver, and in fact, they're already doing so. They're going to have to maneuver to devalue the currencies in which this debt is denominated. This is very relevant to investors because essentially currency debasement means massive loss of value in real terms for, first and foremost, currencies, but also bonds, and to an extent other asset classes as well, such as certain type of equities, etc. So as we are facing mounting level of unprecedented debt, the odds of a significant devaluation of the currency ahead are growing exponentially. So this is really what's happening, and that's what investors should sort of start to get ready for.
Pietro, so when it comes to paying down debt, I mean, there's really, I suppose, traditionally two ways of dealing with it. One is raising taxes. This is from government debt's perspective.
Right.
And the other way, as you sort of alluded to with devaluation of currencies, is to trade your way out of it, increase GDP. They're the traditional ways. The new way that's been added to the mix is what they commonly now refer to as quantitative easing. Just print money, which in reality is not actually reducing debt. It's just moving it off the balance sheet from the government to the central bank. What's your view, therefore, with regards? I mean, we've now seen a change in government in the US. I could only assume that the Democrats will be looking at, this sort of new. I don't like using the word socialist agenda, but it's definitely one where they talk about better equality and distribution of wealth. Do you see part of that sort of being a combination of new trade agreements, reduced taxes, and more or less quantitative easing going forward?
This is sadly, is a very easy question to answer, because in fact, we already kind of know the answer. Janet Yellen, who's about to be confirmed, I think probably on Thursday next week, as Secretary Treasury, she has already said that this is the time to think big. What it means essentially is that the Treasury will be essentially enabling more and more fiscal policy, which in turn has to be financed by the central bank, as you pointed out, which in turn means further massive issuance of debt from the central bank side. So we will see the fact that Janet Yellen will be the Secretary of Treasury, and she, of course, she's the previous Fed chairman. We will essentially see a fusion of monetary and fiscal policy, which obviously speaks to the end of that sort of kind of bad cop, good cop dynamic, which it was typically of most countries of the last decades. The end of that bad cop, good cop dynamic means that there will be virtually no restraint to issuance of debt. The debt, as we know, is essentially covered through, as you pointed out, through monetization of the debt itself. So essentially the Treasury issue the debt and the central banks buy it. So we will see not only more QE, obviously QE is a very generic word, not only more sort of extreme monetary policies, but also extreme fiscal policy. Well, instead, obviously, over the last decade, before the Trump tax cut and before COVID, it was primarily a monetary stimulus. Well, instead now we'll see growing monetary stimulus and growing fiscal support. So yes, so that is the I would say, I don't want to say obviously nothing is certain, but I would say the odds are overwhelming to that scenario, because the opposite essentially means staggering depression and recession on a global level. So we are pretty sure that the governments will not gonna want to go that way.
Yeah, Pietro, let me jump in here with a question for you. We've got 30% of US households at the moment that are behind on their rent. That's a staggering figure. We've obviously seen equity markets, high-end real estate, any scarce asset has been appreciating massively with all this QE. Could you talk to the audience about, clearly if you're in the capital class, you're kind of doing okay. Could you talk to us a bit about how you see the equity markets behaving in the coming year? And then maybe if we can move into some investment strategies for, the various sort of levels of people watching this, right from somebody who's holding equities to somebody who is literally sitting on some cash. And we'll go through the different scenarios and what you feel are good investment strategies. But who are the winners and losers here, and how do you see the next year playing out with the equity markets?
So one of the most staggering, I think, for any person that is sort of kind of privy to financial markets, one of the most staggering observations from last year is how the massive disruption, the massive economic disruption brought about by COVID was also paralleled by this incredible run of financial assets. So the S&P was up almost 17%, long tenure bonds were up about the same, gold was up, of course, Bitcoin was massive, everything was up. So how do you explain that while the economy is facing, to your point, where real people are facing real economic and financial challenges, how do you explain that? Again, the answer is in policy. And the answer is in interest rates that have never substantially been lower on a real term basis in history. So we're basically now, real interest rates, which means nominal interest rates adjusted for CPI, are the lowest that they've ever been in known history, meaning that the other two periods, which are somewhat analog to what we are going through, which is the 1930s and the 1970s, 1930s, 40s, and 1970s, real interest rates were actually higher than what they are today. And that lies the answer about equity. The reason why equities had such a massive run really has to do with interest rates. First and foremost, because equities are valued through discounted cash flow analysis. And discounted cash flow analysis essentially is a function of the so-called risk-free rate, which is really the treasury rate. So if this rate is super low, you take a company like Amazon will make X amount of money over the next 10 years or 20 years. If you discount back that amount of money using a very low interest rates close to zero, then the present value of the cash flow is very high, and therefore is supportive of extremely high valuations. That's why there is this apparent dichotomy between Main Street and Wall Street. So if you understand that, then the forecast for 2021 is frankly more of the same. In other words, the conditions that push the market to the current levels in 2020 are actually not only persisting, but they may actually become even stronger. So the equity markets are likely to stay buoyant. Again, you got to understand that equity market is a generic word. Within the equity market, there are different sectors. One of the things that we're seeing, for example, last year, if you take out essentially mega techs out of the S&P, if you take out certain sectors, the S&P only was up, I think if I remember correctly, 5.2%. So the difference is made by these, relatively few companies that obviously have, are for very good reasons, had massive appreciations. So the outlook for 2021, is going to be maybe not as good as 2020. 2020 and 2019, by the way, were absolutely, from an historical standpoint, exceptional, but I would still see that 2021 is going to be, a good year for the equities, although there may be some ups and downs. So again, I don't want to get too technical unless you're interested, but basically there is a possibility of a correction ahead. That correction will be met by yet more stimulus, and therefore the stimulus will essentially create the kind of buy the dip effect, reflexivity, and which will push the market up once again. And I think we'll probably close 2021, with a significant sort of plus sign.
So can I just add in there, because I think you made some excellent points. However, there's a sort of school of thought here, and let me explain. Probably the most recent similar sort of period that I believe is closest to reflecting today's situation, although not nearly as severe, was actually that period in the early 90s where, we just came out of sort of the Reagan era, which was also extended by George Bush Sr. That was a period of high growth, but also an accumulation of debt in the US markets, which, does drive the global economy. And there was obviously a lot of fears at that point as, the Clinton administration was taking over with regards to America's ballooning debt. Obviously, relative to today, it's almost a joke, but it was considered to be quite high at the time. And what happened was the unexpected. We effectively had the dotcom revolution. We had a transformation occur in some of the fundamental aspects of how the economy worked with the advent of e-commerce, more efficient supply chains. Effectively, technology in general was creating massive efficiency benefits across the economy. Greenspan, who was the head of the Fed at the time, actually kept interest rates low, and the effect actually turned out to be record levels of employment and massive economic expansion, largely driven by what is now referred to as that dot-com boom period. There was a correction in 2001. However, relative to today, that correction could be seen as literally a blip when it comes to the amount of economic activity that continued to flow onto the new internet, or the expanding internet, and has continued to this day. In some respects, I think COVID was the final nail in the coffin for the old economy pre-internet that has delivered a lot of these economic benefits. And I'm just thinking, with the benefit of hindsight, central bankers today, as well as some of the more sophisticated investors running these large global funds, are plowing their money into the equity markets as well as other alternative assets, because they believe that we are on the verge of yet another wave of economic efficiency and expansion being driven by technology innovation, which ultimately will depress inflation, which normally would have occurred from this amount of economic stimulus over the last decade, because it will be offset by increased inefficiencies. The unfortunate fallout from that is that there could be a longer period of time where we have to coexist with high unemployment rates. But in a society where innovation is becoming more of a driving factor, I think employment as a KPI is becoming less relevant. What are your thoughts there?
Lawrence, this is obviously it's a super important and fascinating topic. Let me just kind of give you a few reactions. Well, first of all, 1990s was a time of essentially, especially in developed economies, of very low debt. So there was, for example, the U.S. government debt. I think it was about 40% of GDP. Today is 130, going to 135. That's number one. And that is important because essentially the level of debt in the economy is a key driver, inverse driver of productivity. So the Greenspan era was characterized by very high productivity gains, which instead have disappeared over the last 10 years. So so something is, let me put it this way, in a very simple way, something is broken between the objective increase of digitalization of our society, which of course enables us to do things kind of better and faster, and the productivity gains that trickle to society. That is what is broken. And two of the reasons, very simple, on a very kind of economics 101 basis, is that the productivity of capital essentially has disappeared. So because interest rates are so low, because debt is so high, because of policy, so capital is really not $1 of capital invested doesn't really generate $1 of return. Number one. Number two, and this is a very important and troubling issue, is that the productivity of labor has collapsed. Why? Because a lot of these technologies not only don't require the same number of labor, the same unit of labor of the pre-technology sort of production of good or service, but in fact they require a lot less. So we are facing some systemic as a society, and again, I don't want to get to social logic here, but we're facing some it's an inflection point. We need to figure out a number of issues. Obviously, COVID has pushed digitalization, which is in turn has disintermediated maybe 10, 15, 20% of the labor force. What are we going to do about that? These people that have been disintermediated, especially from services, but it will be more and more in manufacturing. For example, one of the trends that COVID is bringing about is reshoring, which means more automation, which means less employees needed, less labor needed. So the question is, first and foremost, these people, they need to be supported, hence continuous subsidies, hence increasing government debt, increasing government deficit, and increasing stock of debt. But also there is a bigger kind of social issue, which is you can't just, if you just send us a check to people every month, that doesn't quite solve the problem, as we all know. Also, these people are clearly starting to represent a very significant sort of political constituency, which in turn brings about the rise of, as it always happens in history. By the way, what is happening now has happened in history X number of times. So there is obviously the moment that income inequality reaches a certain level, there is a rise of populist political platforms, which in turn creates political instability. So that's exactly what's happening now. So these are all, I like it. Obviously, we can talk about it from a variety of point of view, but I think it's really more interesting to look at, okay, if you're an investor, if you have some savings, if you have some wealth that you need to protect, what do you do in the face of what's happening? That's, I think, is really the key.
Yeah, actually, this is where I want to take the conversation next, guys. So, obviously we've got M2 that's going absolutely parabolic at the moment, but a lot of that's, as we know, is really sort of trapped in that banking system. We're not really seeing it trickle down as much as everyone would like. Pietro, you just raised that point there. I mean, what do we've had the likes of a Michael Saylor put his corporate treasury into Bitcoin, 1.3 billion, I think, at last count. His attitude is that cash at the moment is a liability. So we're seeing that play from institutions, but if we bring it back a bit here for, as you say, people that maybe have some cash to invest, what are your thoughts around putting that into Bitcoin specifically and the wider crypto market?
Yeah, I mean, this is a problem that whether it's a corporation, whether it's Michael Saylor, whether it's just the man on the street, I think the key question is, if you have a surplus of capital, if you have some savings, how do you protect the future value of the saving? This is really the key question.
Yep.
Michael Saylor makes a very compelling point that basically says, given the rate at which the monetary base is expanding, unless you are able to invest at the higher rate than the rate of expansion, you're essentially losing money.
But 15% is the number he's throwing out.
Exactly. And this is really, frankly, guys, it's from an historical and economic history standpoint, clearly what's happening in terms of, again, monetary and fiscal policy does clearly point to accelerating loss of value in real terms of cash, but also a variety of other assets. So the question is, what do? Well, you need to migrate, and this is exactly what's happening. You need to migrate at least a part of the savings into an asset that is more likely to retain its value, to retain value. You need to essentially look for a store of value. That is really the key issue. The key issue is that in this kind of situation, historically, someone that wants to protect the value of his savings has to allocate into store of values. And so this is really kind of what Michael Orseiro is doing with this company corporate treasury. Of course, in the case of Bitcoin, there is a convexity issue, if you want, that obviously is not just protecting, but actually it's increasing the value because of the network effect and the increasing adoption of Bitcoin, et cetera. But basically, that's the idea.
Do you think the shift into something like Bitcoin, because really, you know, if you were to say people are investing in Bitcoin because it is increasing at a, you know, appreciation rate in excess of 15%, almost would be sort of making an equivalence to I should invest in tulip bubbles, you know, back during the tulip boom, because they too were increasing in value at a fairly accelerated rate. Do you think it's really just a case of FOMO here, or do you think that there is sort of a fundamental economic benefit that Bitcoin ultimately is going to play in the future that is driving this investment?
You know, this is actually, Lawrence, this is the key question, right? Because what I find fascinating is that Bitcoin is really, I believe that very soon investment in Bitcoin will be characterized as flight to safety. That is really what Bitcoin is becoming. So as more and more people, and again, obviously, I'm sure you have talked on this program, you have talked about, you know, very important investors and even pension funds and family offices starting to allocate to Bitcoin. These people, of course, there is always, you know, there is maybe part of the agenda which is, you know, capital appreciation, but the main reason is really flight to safety. And I know that for some people that the concept of flight to safety and Bitcoin may be confusing because of the volatility, but that's really what it is. Incidentally, the volatility, the Sharpe ratio of Bitcoin has been over the last 10 plus years better and higher than virtually any other asset class. So the idea that Bitcoin is volatile, it is volatile, but on a risk-adjusted basis, actually the return of Bitcoin has beaten everything. Incidentally, tulip and other bubbles don't last 12 years. They last typically much less, right? So the flight to safety is really the investment case for Bitcoin. However, as the adoption, you know, increase, what happens given the you know, mathematically supply constraint, the increased adoption makes the price essentially pushes the price very high. So what you do, you get essentially a double effect when you invest in. On one side, again, you are essentially allocating to a store of value. On the other side, you're creating this massive alpha, at least for, you know, for some time. At some point, I believe at some point the value of Bitcoin will sort of kind of start to flatten once the adoption has reached a certain level. And I'm sure you're familiar with some of this analysis. I've done it actually. If you're interested, I wrote an article in 2017 when I was kind of using the same kind of type of analysis, and I was forecasting, again, I think it was August 2017, I was forecasting $77,000 for Bitcoin as kind of an initial kind of baseline fair value, which essentially was the equivalent of 1% of high net worth individuals' capital allocated to Bitcoin. So, and you can use any parameter you want. So, but basically, once that sort of kind of adoption start to slow down, then the appreciation of Bitcoin will also start to slow down. And at that point, you will have two things. First of all, you will have the possibility of using Bitcoin as a mean of exchange, because at that point, the value doesn't fluctuate so much, then it's a lot more viable as a unit of account, a mean of exchange. On the other side, at that point, the Bitcoin ecosystem will be so developed that you will have, for example, life insurance product based on Bitcoin. So obviously, a lot of people in Australia, a lot of people in Singapore, a lot of people in Europe, they invest in life insurance investment products. Bitcoin can be the best life insurance investment product because of these predictable inflation and predictable sort of key metrics. So again, I think we're going to shift maybe sooner than a lot of people think from a narrative of speculative risk asset into a narrative of flight to safety, which is really why the majority of institutional investors are allocating to Bitcoin today.
Yeah, on that note, you raised an interesting point there. I mean, traditionally with any asset, you're always having to figure out the supply and demand equation to make an educated bet. Obviously, that is the beauty with Bitcoin. You've really only got to figure out the demand side. We know exactly what the supply
exactly
is. That's the beauty of this asset. I'm also seeing a lot of institutions, people I'm talking to, they're really cottoning on to the easy money that exists in these derivative markets around Bitcoin, especially futures. I mean, effectively, you can buy a Bitcoin, stick it on a futures market at the moment. You've got zero downside. Obviously, you're not getting the huge upside if the thing takes off, but you can effectively guarantee yourself 20% playing that game at the moment. And I see a huge amount of institutions that are probably going to come into those derivative markets in Bitcoin. Any comments on that, guys?
Well, I think maybe just to finish off, I think where Pietro was leading to in his last point about Bitcoin, I think fundamentally what money is and what we defined as an asset is actually changing in perspective. If you looked at gold or you looked at central bank issued currencies, from the perspective of Bitcoin, what you are seeing is that they are effectively OTC markets for sanctioned tokens that are used as a form of trade. And Bitcoin is actually the first instance where we have a fully programmable, decentralized network for monetary exchange. In other words, what money actually isn't the token, it's the actual network that token is transacted over.
Yeah.
And the reason why these investors are going into Bitcoin is a recognition that this is the first of what is now coming as the future of our monetary system, where the value is actually in the network itself and not so much just in the token. So if the token's tied to the network, and the token has a limited amount of supply, then of course the value of that token is going to go up, which is exactly what Bitcoin is. And I do think that, as Pietro said, it is quite amazing to see it unfold. With regards to these other aspects, the derivative markets that get formed around the network, that's just, in my opinion, finessing to create more stability and to allow more innovation to come in to create products around that particular token and the network it's traded over.
Yeah, I don't know, Sean, if you want to kind of elaborate a little bit more on the derivative aspect. Clearly, there are some aspects of this emerging markets that are kind of troubling, because obviously they enable manipulation. We know that very well from commodities, from gold, from other markets. They enable sort of, interesting enough, on one side, they enable liquidity and risk management. On the other side, they enable manipulation. One difference with Bitcoin is that Bitcoin is different from any other asset because, again, on the supply sort of characteristics, but also the transparency of the network. And therefore, I do believe that there could be some sort of sort of unsavory collateral issues with the real market for Bitcoin, but also believe that the ecosystem will eventually emerge very, very strong. I mean, the products, we are just in the very nascent stage of Bitcoin ecosystem, and the products that eventually will emerge and will thrive will be largely, in my view, will be largely in the interest of the participants, as opposite to the interest of a minority of other players, other participants. And that's really the beauty and the nature of a decentralized platform vis-a-vis to a centralized platform that obviously lends itself to.
That's a great point, Pietro, and I think also quite topical, given the beneficiaries of the first true decentralized network, which wasn't a blockchain, it was the internet, and it was free. And the beneficiaries of that largely today seem to be, the companies that develop search engines and social networks, and also e-commerce platforms. So your Amazons, your Googles, your Facebooks, your Twitters. And the beneficiaries were therefore a handful of, founders, the Zuckerbergs of this world, who've been able to sort of take advantage of something that in some respects was paid for by the public purse, but they got to use for free. Now, in the case of the blockchain, that's obviously a different environment. They're decentralized networks, but now you've got to pay based on effectively usage. Do you see under that environment that there will be, are you suggesting we're going to have a much fairer, more equitable system? Or is it going to be a case where some of the people who are also, you could argue, sort of founding, shall we say, instigators of these networks, and it's not just Bitcoin, it's the others, the Ethereums, the EOSs of this world. Some of them really have little or no utility in the future, but have made some people extremely rich who do hold a lot of tokens and are able to sort of manipulate those markets, or are often accused of manipulating those markets. What are your thoughts around that?
Well, first of all, obviously there is the issue, one of the differences between, on a very basic level, you made a very good point. The internet as a network created value for a relatively small number of participants, which essentially use the network to build an application. So you have the network, which is the protocol, and then you have the application built on top. And the value is all created on the application. So you have, for example, a social media network obviously will create value for advertisers because of data through the application. In the case of Bitcoin, the sort of the equation, the system, the architecture is flipped around, because you have the protocol, which is where the value is created, and then you can have applications on top. And again, obviously, as I said, this is a very early stage, so we still have to see, in my view, what these applications will be and how value will be created and who will sort of appropriate of that value. But what we know already is that because of the reasons what I said, the decentralization and the transparency of the Bitcoin network, I think there is a case that can be made for a more, how can I say, a less concentrated, hopefully, maybe I'm just optimistic, but a less concentrated creation of value than what we see for the internet. I mean, look at just, for example, at something like the Lightning Network, which is maybe the most exciting application, which is built over Ethereum. Anybody can build a Lightning Network sort of platform or app or whatever, and therefore at the end, and also, by the way, you can use any sort of those applications. So it seems to me perhaps there is reasons to be optimistic about the future sort of distribution of the value created by the network. for Bitcoin.
Okay, guys, I want to move into having a look at digital securities. I know you're both experts in this area, so we hope to sort of educate the audience a wee bit on that and understand how that particular sector is rolling out. But maybe just to round off our discussion here of the macroeconomic picture and Bitcoin and cryptocurrencies. I know a lot of the audience are going to want to hear your views on some price predictions and so forth. Maybe you could give that to us, but also I'd love to hear where you think the institutional understanding and adoption of Bitcoin specifically and the wider crypto space is currently at. Could you comment on that, Pietro, and what do you think's coming next in that space?
Two things, one more qualitative, one more quantitative. From a qualitative standpoint, clearly there is, in the cognitive journey to understand Bitcoin and blockchain and decentralized platforms, there are a few sort of kind of milestones. The first milestone is really to understand how Bitcoin is a harder form of money than pretty much anything else. Now, that milestone, I can tell you, as we speak, more and more traditional financial investors, whether institutional or individuals, they're having that eureka moment. They're really starting to get it, which obviously drives adoption. That's on the qualitative side. On a quantitative side, there is one data which I find really particularly interesting, which is a lot of the volume, a lot of the volume, Bitcoins that has played out over the last 12, 18 months has actually migrated from exchanges, outside of exchanges, into private platforms, into private wallets. Yep. And that really, to me, speaks to the nature of the investor who bought those Bitcoins. A lot of the Bitcoins that have been purchased over the last 18 months have been purchased for long-term holding purposes. These have been moved to private hard wallet, cold storage, not to be transacted for a significant amount of time. And that really speaks to the motivation. And again, the fact that they're no longer on the exchange, in fact, the exchanges, the balances of the exchanges are going down because buyers buy and then move out of the exchange to a more secure sort of cold storage. So these two facts really, I think, speak to what's happening on Bitcoin.
Could you throw out a price prediction for us after that comment there, Pietro? You're clearly saying that we've got a supply side shock on our hands here.
Right. So, I mean, clearly, the massive asymmetry between demand and supply, I think it's very likely that will push the price sometimes in 2021. I'm going to guess sooner than later, probably as early as June, between 50 and 100K. However, a couple of things may intervene to, put a cap or even, push to the decline of the price up to an extent. And these are, first of all, there is regulation. Regulation, I think, is coming. Regulation won't be obviously the end of Bitcoin, but it will obviously make an impact. As the price goes up, the odds of closer regulation increases, and I will see will be more in the area of self-custody and taxation. These are the two areas where I think regulation is coming this year. The second possible event may be, and this is something that is somewhat physiological to Bitcoin. So after basically, there seems to be, Bitcoin is basically, it's very mechanic. Bitcoin is a machine, really. So we can start to see some patterns emerging. And it is possible that on the back of, again, what it would be a 3x, 4x appreciation this year, we may see a sort of a decline. And again, it could be driven by, any variety of catalysts, but that decline essentially speaks not to the use case of Bitcoin, but rather to the psychology of humans. Because if Bitcoin starts to really approach 95, close to 100, whatever, you may see some selling, some rebalancing. Incidentally, just FYI, I mean, even if obviously Bitcoin is an important asset, still, if in the context of portfolio management and portfolio allocation, at some point you have to rebalance. I mean, I'm not personally. Obviously, I do the bulk of my work in traditional financial assets. No matter what it is, you can let any asset, any position to become, more than X of your portfolio. So on an aggregate basis, the rebalancing of, especially from more sophisticated, again, family office institution, the rebalancing may sort of trigger a price correction over and above the issue of regulation. So again, 50 to 100 within the year, possibly with some a lot of volatility, and possibly with a correction ahead. As to the extent of that correction, obviously it's a little bit early to say. We need to get to the high first, but obviously, I mean, clearly Bitcoin has shown us that it could correct 50 to 70% easily, and still that would be handsomely returning over the long term. So
gold or Bitcoin, Pietro? Gold or Bitcoin?
Both. You gotta have both.
Yeah, absolutely. I was about to actually say, if you took the portfolio rebalancing approach that's been applied to gold and not assume that they're competing with each other, it's just providing another mechanism to hedge between the, shall we call it, the underlying protocol of the old economy, gold, with the underlying protocol of the new economy, Bitcoin. Gold's current asset allocation across portfolios has given it a total market cap of around $8 trillion. If you were to then draw a parallel there where Bitcoin will eventually rise to somewhere in that vicinity in terms of its market cap, as the global economy transitions more onto the the blockchain networks, then I think we've got because I think the current market cap of Bitcoin when I last looked was only at about $1 trillion. So we still have another 8-fold increase to look forward to. However, that may be playing out over the rest of the decade.
Yeah, I mean, the rebalancing is really interesting, and that's really makes me very bullish on tokenized assets. Because you see, the smartest way, for example, I have clients that are sitting on literally millions and millions of dollars of Bitcoin position. They bought in late 2016, early 2017. So that position, which was meant to be, which was kind of allocated at say 3% of the portfolio, is now huge. So for that kind of people, you have at some point you have to start to think about rebalancing. So the question is, what do you rebalance into? So, and this is really why tokenized assets are really the possibly most important, apart from Bitcoin, the most important trend in financial markets for this decade. Because the smarter thing to do, if you're rebalancing from Bitcoin, would be to rebalance into another store of value. You're not going to just go into US dollars or Australian dollars. That wouldn't make any sense, right? That would fly in the face of the rationale of investing in Bitcoin. So it would make a lot more sense to buy farmland somewhere, maybe New Zealand or somewhere else. It would make a lot more sense to buy a Matisse oil painting, or it would make a lot more sense to buy a Ferrari 1962 Ferrari GTO. Now, the problem with those assets is that the nature of the assets and the markets essentially make the allocation to these assets extremely difficult and essentially only accessible to, you have to be really a very ultra high net worth individual to allocate those assets. And this is really where asset tokenization comes into place. So asset tokenization, in my view, could enjoy tremendous growth from the migration, increasing level of migrations of wealth from traditional asset classes and to an extent from Bitcoin into other real assets, store of value. That is really what's really exciting about tokenization.
Do you think, Pietro, one of my beliefs is actually I think gold's about to go through a renaissance pretty much along the way that you pointed out there. As moving into a fully digital economy is for humanity undiscovered country. It's brand new. And one of the things why people like gold and, they keep it under their floorboards, etc., was always the Armageddon sort of scenario. If everything goes to pot, I've got gold to trade with, And I imagine from a psychological standpoint, as we go through the getting used to the idea that everything we own, every record of what we own is now basically held in semi-state conductors. It's in memory. It's on a network which is now fully decentralized, and supposedly that network is super secure, and it's fault tolerant. You could nuke a country, it's still going to be up the blockchain. There's no issue there. However, at the same time, as humanity is sort of now starting to venture more into space and it grows and increased awareness that there are events such as a massive solar flare where you could theoretically burn out all the tech, on the ground. One of my favorite movies was the sequel to Blade Runner, and they actually have a historical event in that movie. I think it was set in 2047, where there was such an event and all the data got lost. And, anything before that event that occurred, you have a lot of issues trying to retrieve that information. So I actually think because of that, real world assets in particular, property, things of great value that are unique, as well as gold, actually will probably increase in value as we become more digitized over the coming decade and beyond.
I totally agree. Obviously, there is a lot to unpack. First of all, clearly, real assets, hard assets, means a lot of different things. And some of the assets, essentially, for a real asset to have value, you need two things. You need a critical mass of people that attribute some kind of value to that asset, and a sort of a platform, a market platform that enables you to manage and transact that asset. These are the two conditions. So the first one is really a matter of narrative and again, adoption. It's really a matter of storytelling, if you want, right? So we now understand that we are the process of attributing value to something is very much a cognitive one. Obviously, there is a sort of a connection to scarcity. Typically, what's scarce tend to be considered valuable by definition, but there is a lot of things that are scarce that nobody attributes any value to, right? So there is a storytelling component, but then there is a market component. So let's take one of the most valuable store of values over the last, half a century plus is actually a car. It's the Ferrari GTO, which was produced between 1962 and 1963 in 37 only units. And this car essentially is the epitome of store of value. Every time, typically maybe once every 2 or 3 years, typically someone dies, someone very wealthy, someone that had one dies, and the estate puts the car on option. And every time it comes up for option, the price just escalates. And I've actually calculated that since 1962, the average compound return on a Ferrari GTO has been 16.5%. That is pretty long.
Yeah, it is a great example. I think the some of the art and cars,
right?
Are definitely...
So the GTO, right? So now a GTO goes for about 100 million, which means that really you have to be, close to $1 billion in net worth to be able to justify allocating to that asset. However, if that GTO is tokenized, and if investors can allocate on a fractional basis, obviously with all the due governance and legal sort of secure legal wrapping around it, then if the minimum ticket to allocate to the GTO is no longer $100 million, but maybe it's $100,000, then suddenly the potential investors market for these assets escalates by a factor of 1,000, 10,000, 100,000. So that's really what, and that of course unlocks the liquidity premium, which means that then the next time, so a Ferrari GTO which is tokenized probably will be sold not $100 million, but probably maybe 150 or $200 million, because the demand for allocation in that asset classes would be so high that it would allow, again, it would reduce the liquidity sort of premium and therefore unleash the price. And that is true virtually for any of this kind of, whether it's a painting, whether it's a there is impressionist rather than, but even 20th century paintings that have, I think, a very interesting track record in terms of appreciation. There is obviously real estate. I mean, real estate honestly is a big word. I think you got to be super selective when it comes to real estate, because real estate is not, again, it's not a painting or a car. Real estate has to do with really objective kind of valuation and sort of kind of productivity, economic productivity parameters, meaning that if you're buying overvalued, guess what? That's not going to protect your savings. That's going to destroy your savings. And that's the same for commodities. Obviously technology is disrupting the world of commodities, and therefore, in commodities investment, which is one of the sort of real assets investment par excellence, may not be good if the value of that, if the use for that commodity, decreases due to technology or other factors. So you really have.
Can I just jump in quickly here, guys?
Yes.
I think you're two of the better people to help educate the audience on the tokenization of everything, on security tokens. Could you put some context around where we're currently at? Obviously, we've gone through, analog, getting a share certificate for something. Then we went into the electronic age. We're obviously moving into a blockchain scenario now. Where's it at? I mean, can I buy a piece of real estate now? Can I buy that piece of that Ferrari at the moment? Where are we currently at? Obviously, I've been educating people on Bitcoin, and I still see sort of on-ramps to actually buy some of the stuff. It's still quite difficult. Are we having to go through a similar thing with the securitization of everything? Talk a bit about that for us, if you could, guys. Lawrence, do you want to kick it off?
Yeah, I suppose, we are seeing... obviously, a number of real-world assets, properties of quite a popular area. Art is another. That effectively the funds that are being set up and then being used to invest in these particular products, which are then held in custody, those funds themselves are actually tokenized, so that investors are able to invest in the funds more conveniently and hold it as a digital security. In real world assets, there's a lot of gold-backed tokens out there. What we're seeing now, I think in that industry, is sort of product innovation occurring, so that, for example, at the end of the day, a financial product's created, as a form of being able to raise capital to invest in that particular, governance of that fund or that investment product. So in the area of, say, gold or any type of resource for that matter, you're now starting to see funds being formed that are tokenized that allow you, the investor, to take direct ownership in unprocessed gold that is a proven reserve, as an alternative form of allowing mining operators to be able to raise funds instead of basically issuing shares on the market or doing it through a private issue, are able to do that through a digital securities exchange where they're effectively selling off part of that proven reserve at a fairly, generous discount to spot, therefore allowing them to raise money without dilution of their underlying equity in the business, and for the investor to be able to buy gold at a nice discount to spot without having sort of the carry costs associated with derivative products, which would normally allow you to do that. So, there's a lot of innovation coming down the track where we'll see, digital securities providing investors with ease of participation, and therefore also allowing for greater liquidity to occur in those assets in the case of cars or real estate that traditionally not liquid, may have areas, art, for example, in economic depression sometimes is hard to move. So if you can create markets where it's easy to own pieces of the art, fractionalization, you actually start to solve a lot of those issues, and therefore you allow greater participation because people know they can get in and out easier of those assets.
Sure. Pietro,
Well,
you want to jump in?
yeah, I would, first of all, I would distinguish between financial assets and real assets, right? So on the financial asset side, obviously, first of all, the technology and what have you is already all available essentially off the shelf. So from a tech standpoint, there's really very little that needs to be developed. Obviously, different story on the legal and sort of corporate statutory side and commercial side. So on the traditional financial asset side, I think private equity and venture capital are the sectors, to Lawrence's point about the gold mining, are the sectors that are kind of more ripe for tokenization because of the liquidity component. So if you can, obviously one of the issues with PE, one of the issues with VC is liquidity. So if you can use tokenization essentially to enable liquidity much sooner than the liquidity event that would otherwise allow investors to cash in, that is great. However, this particular sector is also facing the biggest headwinds in the way of, legal, statutory, and commercial. Again, it has to do with cognitive, basically, nothing to do with technology or use case. When it comes to real assets, the story is slightly different because while on the traditional asset side, you do have, reasonably efficient, tried and tested, legacy systems. On the real asset side, the systems are really not particularly, efficient or useful to invest. Obviously, in the case of real estate, a lot of markets that are quite interesting. Actually, it's really difficult for a foreigner, someone that is not, doing business or residing in the market, it's really difficult to buy. Or I talked about art or the vintage cars. So these markets, again, real assets as opposite to financial assets. These assets, in my view, perhaps represent kind of a slightly lower hanging fruit use case for tokenization. I've actually invested about almost 2 years ago. I invested in a company in US which has very successfully tokenized land in the US. So at the moment, it's only open to US buyers, but they have been doing very well. It's called Fabrica, and you can find the website at fabrica.city, and they've done fantastic to just in that specific segment of the property market. I think there are great opportunities, especially again in real estate. Everybody gets investment in real estate. Obviously, there is always the caveat, the catch of valuation. Clearly, if you're buying, for example, today a property in London, to be honest, I'm not sure. I'm not saying it doesn't, but I'm not sure if that is really, once adjusted for valuation, that is really a store of value. However, you may be interesting to buy a property, maybe, I don't know, in an emerging market, whose fundamentals and valuation is a lot more supportive of a store of value case or even an appreciation case than other markets. When it comes to gold, I find gold fascinating because gold is the perfect asset to be tokenized, right? Because it essentially is indifferentiated. So you got a bar of gold. The only difference is the weight and the serial number. And yet, very interesting, again, the biggest hurdle is always cognitive. Only today, less than $100 million of gold is tokenized, which I find it really staggering. Again, in a market of $8 trillion, you would think that, wait a second, tokenization is ideal for gold. You can essentially own it, transact it, use it as a collateral, which is typically very difficult to get funding. And yet it's nowhere. And by the way, there is a number of really excellent companies that are doing, just to mention a couple, there is a company called Digit in Singapore. There is obviously Paxful, Paxos Gold that is doing it in the US. So there is plenty, it's not some kind of, exotic. No, there is already very well functioning, audited, secure platforms, and yet has not taken off as you would have expect. Again, the problem is cognitive. If you're really into gold, if you're into physical gold, getting digital, getting tokenization, not so easy. And if you are not into gold, if you are, say, for example, a millennial, then you already got your gold, which is Bitcoin. So it's really very interesting to see how gold has yet to become a powerful use case. Just one thing. I mean, obviously, I've been been making the case for Bitcoin for many years, but there is one thing that gold is superior to Bitcoin for. There is one aspect of gold that makes it superior to Bitcoin, and that aspect is that gold, and I'm talking physical gold, doesn't come with any tech debt. Meaning, to what Lawrence was saying, Bitcoin essentially as a tech debt. In other words, if you own Bitcoin, you need the minimum infrastructure, a minimum sort of level of infrastructure that essentially is the network, enables the functioning of the blockchain, right? With gold, you don't. If you have a bar of gold, that's it. You don't need anything else to realize, to fulfill the promise of store of value of that asset. So that is the big difference. And of course, now, we know blockchain is extremely resilient. There is satellites now where blockchain is uploaded to. Clearly, you could, for example, have Bitcoin transaction in space or on the moon, which of course with gold you cannot do. So don't get me wrong, I'm not, but gold really has that kind of unique feature of not having any tech debt, and therefore to me will continue to at least for the time being, will continue to have a role in a proper sort of kind of asset allocation strategy.
Okay.
What do you think? Your big predictions? Maybe if we take just the next 2 years, what do you think we're in store for that maybe is not being talked about, at any great level at the moment?
Okay. So this is what's happening on the macro side, the amount of debt and the velocity at which this debt is being created, and the velocity at which the liquidity that is necessary to finance that debt is being created is nobody's secret. So I have to believe that all major central banks must be studying and trying to figure out a plan to work this issue out. You just can't ignore it, number one. Number two, such a plan, in my view, just looking at history and just looking at the way the system works, cannot be implemented on a single nation basis. It has to be implemented by at least a critical mass of countries at the same time. Let me call it a new Bretton Woods Accord. So obviously there is, this could be a very long conversation, but basically what would this Bretton Woods Accord stipulate? My sense is that we may see essentially all major economies, all major central banks deciding to take one-off major write-off on their balance sheets in terms of debt. And the way, obviously, if you have a very large amount of liabilities on one side, you need to figure out how to increase, how to sort of balance out on the other side, what to do on the other side in order to manage the liabilities. And so one possibility may actually involve gold, because if they decide to say, okay, let's assume we're going to revalue gold at, let's call it $20,000 an ounce. Then what happens is that the gold sitting on sovereign balance sheets is massively appreciated. And therefore that reduces the debt to GDP value of those countries. So obviously that would have a sort of obviously another consequence, which is that would probably, not probably, for sure, debase the value of the currency. Okay. However, now you have this huge sort of position on your asset side, and therefore you can take this money, you can essentially monetize gold, and you can invest it into the economy to generate the kind of growth which essentially is going to reset the debt for good. So this is something that I know it sounds really, obviously it's a little bit extreme, but something. So my guess is something they're going to have to do something sooner than later, and they're going to have to do it in coordination, because you just cannot do it on a one country basis, because that will mean the massive appreciation of the currency on other side, et cetera, et cetera, et cetera. So just the unintended consequence of just one country unilaterally doing that are just not very likely. So that's a kind of a far out scenario, but I think it's not far out to think that over the next couple of years they're going to have to figure something out. One thing which is really important, and again I wrote an article recently, is the launch of central bank digital currencies. Central bank digital currencies are a game changer. I really encourage everybody to start to put them on your radar, because they are the game changer in the global economic and financial world. And again, that will be part of the solution, but they can't just be all the solution, because at the end of the day, the money on the balance sheet is the same, whether it's digital, whether it's paper, is the same. Of course, with digital, there's a lot of things that you can do. Essentially, it's programmable money. So with digital, for example, it's very easy to create inflation. For digital, it's very easy to deploy narrowcast tax policies. But clearly, still, you're going to have to figure out a way to reset the system for the debt that has been created.
Yep.
Yeah, I have to agree.
We actually covered the CBDCs in detail a couple of episodes with Lawrence and Simon Dixon. I'll put a link below if you want to check that episode out. It was a bit of a masterclass in what's happening on that front. Look, guys, we could literally talk for forever here. I think there's so many topics we can cover, but Pietro, would love to have you back on again in the future. You're certainly a very knowledgeable individual on a number of fronts. I know you're also doing a lot in the digital security space, and maybe we could have you back on in the coming month or two to delve a bit more into the specific projects that you're working on there. So listen, thank you so much for your time, sir. Lawrence, any sort of final questions or comments for Pietro?
No, I think we covered quite a bit of ground there. I was just commenting at the end. I definitely agree with Pietro about how digital currencies are a game changer. The ability for governments, I think, to be able to collect more revenue through some sort of automated way to tax, I think is an inevitability here. And the only way they're going to be able to pull that off is replacing their existing OTC tokens, better known as cash, with a digital version, which is the digital currencies that are coming out. But yeah, it's very much a pleasure to have you on, Pietro. Excellent conversation, and I I think there's definitely more that we can cover. It'll be great to have you back sometime in the near future.
Thank you, guys. Pleasure to join you today.
Excellent. Thank you very much, sir. We'll see you
Bye-bye.
very soon.